Hello, 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 everyone. Welcome to episode 20 of
Mhm.
Inevitable Wealth Podcast, where we help break down financial news or financial
Mhm.
concepts on your day to day and help you understand. So I'm Jacky Petit-Homme, and I am here with Julian.
Hello, everybody. Thanks for joining.
And today we're going to do something different. We're going to talk about your wealth management journey
Mhm.
and how it evolves over time, right? How do people find advisors? How do they sometimes end up landing with advisors
Yep.
when it's intentional or not?
What's the difference between firms? What do things look like? We get this question a lot, especially from friends, family. What does Liberty One do? I have a guy at Northwestern Mutual, Edward Jones. What's the difference? Merrill Lynch, where we all came from. And it can be confusing, right? We're very well versed on it because we're in the space, but for the average American, it all feels like the same or overly confusing. Analysis paralysis comes into play, et cetera, et cetera.
Yeah, etc. Yeah. So before we get into anything today, we want to be very clear that there are strong, high integrity advisors at every type of firm. We've met them, we know them. We've been around long enough that I don't think there's really a type of firm that we don't know someone who's been working there for a long time.
Exactly.
So this isn't to put them down or anything like that. This is to just explain the differences and see what makes most sense for folks out there in different parts of their financial life.
Yep. So we've noticed over the years, most people don't necessarily intentionally choose their advisor, right? They fall into different models based on timing, circumstance, or who reaches out first. So we're going to break down the real journey, right? What they experience as they move through the options, right? As to what they look like. So first, there's typically insurance first firms like Northwestern Mutual, New York Life. Then they often look at workplace plans like their Fidelity 401k. They feel like they have an advisor there. Or call center advice, right, through Merrill Edge or something like that. There's often firms like Edward Jones next that come into play, wirehouse firms, and then finally we can talk about independent RIAs and what that looks like, similar to what we are. So no stage is inherently wrong, but each operates differently, has different incentives, and offers different levels of planning. So it's about finding what the best fit for you is.
All right. So let's call this the starter stage, insurance-based firms. And if you know it's an insurance-based firm, a clue is it ends in a mutual, Northwestern Mutual, Mass Mutual, New York Life, Guardian, you name it, right? These tend to be insurance and I would say product leaning firms. And how do people get there, Julian?
So they do. Anyone with a pulse has likely been reached out to by a Northwestern Mutual, Mass Mutual type advisor, New York Life. That's because they have very heavy recruitment on college campuses and for young folks. So they outreach to friends and family. They say, it would be a good fit, a disability policy. We had someone the other week, they were sold a life insurance policy. They have no kids. They have no dependents. I would say, what would happen if I got hit by a SEPTA bus? In this case, they don't have anyone that needed their income. So it was a unique recommendation for sure. But because of that, because of this high recruitment, we've all been contacted by someone that works there. Hey, I'm a new graduate of Temple. What you have time for a discussion type thing? What would you add?
Yeah, and and we should talk about strengths that support. We were trying to be fair here.
Yeah.
So the first is it's a good introduction to protection planning. Again, insurance is vital. It also encourages early saving.
Yep.
And also more often than not, these mutuals are very relationship based, right? You start there as if you work there, they say, hey, pull up your contact list and let's reach out to folks who might be interested in your services. The thing is, on the other side, is these are, again, product-driven type entities. So compensation is tied to products. And I believe it was Charlie Munger, right? Show me the incentives, I'll show you the activity, right? So if their incentive is just to sell you something, then they may or may not be around to make sure it works out, or
Mm-hmm.
continuous planning. Also, on the other side, like you mentioned, insurance is sold whenever it's needed or not, right?
Mm-hmm.
Everything is a nail to a hammer. So if insurance is the only thing in their toolbox, when you need to save for college or retirement,
Mm-hmm.
sometimes they might not have the best options for you.
Exactly. Big conflict of interest when it's a commission-based structure, where the products that are high commission that folks need the income, right, to pay rent because they just graduated school or whatever it may be, but that may not be the best fit for the client, right? We just had someone that started working with us. They were with a Mass Mutual affiliated firm before. They had 55 holdings in their IRA, and about 14 of them were municipal bond funds. So what that means is they were extremely tax efficient in an account that doesn't pay taxes.
Yeah.
So getting less yield for no reason,
Yeah.
which you say is
Basically, it's like wearing a raincoat indoors.
Knew that was coming.
Yeah.
So
Layup.
so it's not always as client centric as market agnostic as product agnostic as it could be, I would say. But everybody's different, and most folks tend to move on from that type of firm as they become more educated, and then they move to the workplace type provider, right? Your 401k, it's typically with Fidelity, it's typically with Merrill Edge. So we talk to folks and they say, I have an advisor. He works with me at my company.
Yeah.
Now, pros to that, they can see your 401k, they can help you contribute, they know your salary generally, if you don't tell them. So you certainly have help there. A lot of robo-advisors, so you don't necessarily need to pick the investments, which is certainly nice. Tends to be low cost, which is beneficial, but you always want to double check. Sometimes that can vary. What would you say, what would you add? Pros, cons, what do you got?
I would say one of the strengths as well is within the 401k, like you have someone that you can just like reach out to that knows the plan, knows the options, and may also know some of the other benefits that might be afforded to you through your employer. I also like the fact that usually the portfolios are simple, right? A lot of the families that we serve like just like a target date fund.
Yeah.
Just like make it simple, low cost, almost like a set it and forget it investment. And those are the good part, the good things.
Yes.
Yeah.
Yes.
But some considerations, I'd say, is think about it. If you work at a company, it's a large corporate office, right? And you're one of 10,000 employees.
Yes.
Guess what? They don't have 10,000 401k representatives that are one-to-one, right?
Yep.
Again, we have folks that are at the Fidelities and at the Vanguards, and they have easily 200 to 300 clients that they're responsible for.
We have contacts that work at Fidelity, and they have 350 families that they are responsible for.
Yeah, one person.
You can't possibly get to know 350 different families' unique situations enough to give high quality advice or be proactive, right? It's a very reactive type environment if you're working there. So with, my dad always says what you pay for is what you get. And when you're not paying all that much or it's almost hidden, right? You don't necessarily get the most first class service, right?
And what I would say as well is I know a few folks who use these advisors, but what it works out for them because they're very proactive on their own. Like they're very cognizant of what's going on in the world, on the markets, in their financial life. So they know inherently, oh, I have to reach out to my person at Vanguard. But for us, the folks that we serve, they're like, I don't want to think about this until Jacky tells me I should. So different strokes for different folks.
Also, nobody really finds any issues when it's a bull market, right? When you're in a high growth Fidelity strategic private client group, you don't mind what you're paying because it's high growth. You don't mind not getting called because the market's been good. The second there's volatility and you have asymmetric downside risk, that's when you start to say, I don't know, is this best fit for me? And then all 350 people call the advisor at the same time,
Yeah.
and they can't possibly get to them as actively as they would like.
Yeah, like a long hold time.
Yeah.
And also just one caveat as well, they are not allowed to give you any advice on anything outside of the actual 401k.
Correct.
So if you have even in an IRA at the same custodian, or if you just ask them, hey, is this like a taxable distribution? They say, well, we'll send you the tax notice. And then you can read this 80-page document written in a different language that looks like English, but it isn't.
And counter to the mutuals of the world, they don't talk about the insurance side, which a lot of folks, I would say 90% of folks, are missing term life insurance, right? Very cost-effective, very cheap way. I have it myself to make sure your family's protected for future education, to cover your mortgage if something were to happen to you. It's very, very cheap, but that's something that's certainly lacking when you strictly rely on your 401k provider, right? Because you don't have that balance. You don't have that holistic approach. It's just that one thing that's covered. Third, I have the neighborhood/regional advisor or the commission-driven type situation. So this I see as like an Edward Jones type structure where they have, if you've ever seen Edward Jones, if you've ever been in the middle of nowhere, a lot of times they always have an Edward Jones office. They are known for their local advisor presence. So they have thousands of these neighborhood offices where they do face-to-face service, which is nice, community engagement, which is nice, and they do tend to be a little bit more relationship-driven.
Yeah.
What would you add? Anything come to mind as far as positives for these types of firms?
Yeah, I would add to that as well, like your Ameriprizes, your LPLs. They're not like the big, huge, like the Merrill Lynch's or JP Morgan's of the world. And yeah, I think the folks that tend to work with those is like, yeah, this is someone I've known. They go to my church or place of worship, and they're very like local. I think that's usually, I've seen the strength is like, yeah, there's an office right around the corner in your neighborhood. You could come in and sit down, which isn't insignificant. You know, some folks prefer to still be kneecap to kneecap. Right.
And he goes to my church is a very common refrain we hear from people.
So I don't have anything too much against those folks. One thing I do have against them, which I gotta be honest, is big revenue sharing type firms, which basically means, especially specifically Edward Jones, they are supposed to be fiduciaries. You know, they are, if they're CFP, they have to be fiduciary. And whether the advisor themselves know it or not, they're pretty much pushed to push specific mutual fund families, which not my cup of tea.
I was reviewing an Edward Jones portfolio about 2 months back, and it's all American funds mixed with Eat and Vance, and they were higher cost funds. And I said to the family we were helping, is there a reason you chose these funds or the advisor chose these funds? And they said, I don't know. I know the reason, or at least I feel like I know the reason. It's because that revenue sharing component, where when a advisor sells an Edward Jones, or at Edward Jones sells an American funds fund, Edward Jones gets a cut of the revenue. So for example, in the year 2024, Edward Jones received $125 million from American funds for using their products. So it's a way for them to receive more revenue, not necessarily off the books because it is disclosed, but not always with full awareness of the client, right? Because are you choosing what's best for said client, or are you choosing what's best for said firm? Is something to think about. So that's always a huge conflict of interest that we come across. Especially when they're selling commission-based American funds, A shares, things like that, which is a little bit more convoluted. But the bottom line is it's expensive and it costs you money. So know what you're buying, know why you're buying it, and make sure it's in your best interest.
Yeah. And also, I'll just take this quick caveat to say, I'm not a big fan of mutual funds, especially it's 2025. Mutual funds came about because they say, hey, we're going to beat the market with active management. That's why you should pay these costs. Sometimes upfront fees of up to 5 or 6%, an additional internal 1% or more. That we have data now. No one beats the market. So, in my opinion, consistently. There it is. That's a good word there. In my opinion, we should not be paying these fees to quote unquote beat the market when no one is consistently beating the market.
Exactly. And our philosophy is cost, tax efficiency, and risk. So cost is very straightforward to control. Don't buy the expensive fund that holds the exact same investments in it as a Vanguard or a cost-effective BlackRock fund, things like that.
So I guess that's pretty much it for the regionals. Anything else to add for that?
No, and again, not trying to say that everything is bad at certain places, but show me the incentive and I'll show you the outcome. So just want to be cautious as if you're choosing a specific place, you should know the pros, the cons, and everything around that decision.
And ask why these investments. I think
just ask why.
Any firm that you talk to, even independent firms, like, hey, why are we using these funds? Why are they costs? Folks, we talk to families or introduce to families a lot all the time, and they always say, hey, I'm so sorry for having so much questions. And we love questions because we're transparent. We have nothing to hide. I'll tell you exactly how much this ETF costs. It's pennies, but that's what you should be doing. You should be asking those questions and just getting clarity. And then if you're okay with the fee, that's great. But have that intentional decision to say, yes, this is the fund and this is why I'm invested in.
Exactly. The funds we use, the weighted average is generally 0.05%. Somewhat negligible, though that's up to you to decide. But it is very cheap, very cost effective to hold the same companies that a lot of different funds hold. Feel like we went a little long on that one, so I'll jump to the next one. Our former workplace, the big brand stage, the wirehouse firms, right? A lot of mahogany, the Merrill Lynch's, the Morgan Stanley's, UBS, Wells Fargo advisors. Walk through the good, Jacky. Why does it appeal to people? Why did we enjoy working there up until it wasn't necessarily the best option for the families we serve? What kind of made sense?
I think I'll tell folks specifically, like I really at the time enjoyed the brand. I think when I said, hey, I'm an advisor at Merrill Lynch, everyone knows what Merrill Lynch is. Everyone understands. Also, still we have a lot of friends that are there, great people. Like there are a lot of experienced advisors, folks have been around, titans of industry, if you will. And what I liked at Merrill Lynch, and before I kind of understood the broader scope of the space, was capabilities. If a family needed a mortgage or banking services, lending, there was someone that we could reach out to, and it was good. So it was like strong internal resources that I really liked.
Yeah, absolutely. Good research for when that was needed. Granted, we can access that to this day, but they had series of investments that you could choose cost-effective options if you needed. Everything was essentially in place for you. Alternatives, lending on portfolios, things like that were all there for when you needed it. I also enjoyed the networking component where in our office we had 15, 20 different advisors that you could speak to about different situations, which was a big positive, especially early in our career, where you got to know different investment philosophies, different takes on things, learn from others who were in situations you weren't in. So that was always nice, and that was my favorite part. So as we go through it. Now, on the flip side, I would say things and reasons that we made the jump from Merrill Lynch to independence, really straightforward. Jacky talked a little bit about it was great to have mortgages in-house, right? Because everybody we work with, essentially, nearly, has a mortgage, right? Very straightforward. But on the flip side, we weren't able to recommend mortgages elsewhere, even if they were more cost effective, right? You're tied into that platform where if I sent an email that said, Todd that we work with would be a great fit to get a mortgage from here because he can get it cheaper, that would get flagged. And Merrill would say, you can't do that. You have to use Bank of America or else.
Yeah.
Sales incentives. What about the credit card component, Jacky? You remember those
remember.
times?
I do remember credit cards.
Yeah.
A little backup here. So I had a short stint at Wells Fargo Advisors before
Mhm.
Merrill Lynch, and it was during that time of the whole checking account
Mhm.
thing. It was very, very competitive. Everyone needs to get a checking account. If they have a pulse, they need a checking account or savings account. And then when I did not like that, and I started at Merrill. I loved being at Merrill for a long time, and I started to see the same thing where there was incentives and a lot of encouragement from management. Say, hey, listen, your clients need more Bank of America products. And I'm not going to lie. Sure, yeah, sometimes the mortgage made sense, or sometimes a split loan makes sense. But my job is to make sure that the families that I serve are getting the best thing possible, whether it's within the confines of the Bank of America landscape or outside. So it became pretty clear that there was an agenda for shareholders, right?
Yeah.
Because Bank of America has shareholders. And I didn't love it, to be honest. Yeah.
Well, your number one job and our number one thing to do for the families we serve is be objective, right? And you can't truly be 100% objective when you're not allowed to say certain things, right, that are in their best interest. At Bank of America, it was called like We Can Deliver, and it was like you were supposed to do. Remember, Karen? Well, I won't say anything. It was like you have to do 5 a week, and it was like we're not gonna do this because if Steve is a 50-year-old man, if he needs a credit card, he'll ask me. I'm not going to jam a credit card down his throat. That's crazy. He also trusts us with $3 million to manage, so maybe we start there as far as our value add, and on the planning around that. So definitely a unique structure with that cross-selling component. Now, if we do have some friends who still work there, and I think a lot of their success works because they have, for example, one works with athletes, right? And so he likes to incorporate the lending structure with the mortgages, with the investments, and you can do that all in-house under the same brand, which for someone playing 162 games a year or 80 games a year, they don't necessarily want that extra iteration or extra headache of having different things going on. They like one login, which is fair. But I would say that's the best thing they have going. And then on the other side, they have the cross-selling component.
And I would say one thing as well. And this isn't even like, this is not Merrill Lynch. This is when companies get so large, they become defensive, right? I don't know how many, like on average, like 10,000 advisors. So they're playing more defense because of, unfortunately, the litigious society. And when I got my CFP, I was juiced. I want to talk to my families about taxes, their estate planning. I want to talk to them about everything that is important to their financial life. But if a client emailed me about something about their taxes, we were told, refer to your tax attorney or your CPA. If they emailed us about estate planning, we were told, refer to your estate attorney. Not because they didn't want us to help. It's just like they're so afraid of being sued that they just don't want you giving that type of advice.
And on one hand, part of that is reasonable, but there is a line where folks, we want to give high quality advice, and there are things that we do know and can add value to. But even as something as simple as their 401k plan, you wouldn't be allowed to give advice on because it was at Fidelity, and so it wasn't directly under your purview. But you want to be holistic, right? So that was a big part of the reason we made the jump to stage 5, what we feel is the best landing stage for people, but of course we are biased. However, I think if you look at the data, there's a reason that independent RIAs are booming and multifamily offices are booming. Any advisor worth their salt has kicked the tires on going independent, and it's for the reasons we'll go through, right? You get to be 100% objective. You work directly for the families that have hired you and trust you and place their confidence in you. And everything is very transparent to them. You know, there's no $125 million coming in from American funds through the back door. Everything is very, very clear as far as what we're looking at. What would you add as a couple differences as well?
I would also say there's a full fiduciary standard. Like, whether you have cash with us, you have just investments, or legacy holdings, like we have to be a fiduciary 100% across the board, not just depending on the type of account you would have with us. And also, I always like to say, or Julian like to say, like, our parents raised us right to do the right thing. But I think for folks who may not know us, who might have just been introduced to us, like they know that we have that higher standard that we have to abide by.
Because when we were at Merrill, it was you would be a fiduciary on some accounts, but on others you would have a suitability standard. And the difference between a fiduciary standard and a suitability standard is essentially, I was reading, I think a good analogy is suitability standard is, does the suit fit, right? Does the suit fit me? Fiduciary standard is, it has to look good on you too, right? It's a higher standard, a higher degree as far as making sure folks are taken care of. It can't just be an investment that's okay. Hey, it works for you. It has to be the best option for you. Number 1 out of 100, not number 6, not number 22, for you and your family. So the fiduciary standard is what you're seeking, and the unique approach of the suitability standard and the crossed wires as far as when you were fiduciary, when you weren't, was a unique time, and why we moved on, right?
So the strengths, right? Again, full alignment of incentives. We don't have shareholders. Our shareholders are the families we serve. We have to show up every day, like they are our boss. And also holistic planning. I can finally talk about everything that's in their financial life. I always say, if it has something to do with a dollar sign, you reach out to us. We're your resource. Bounce ideas off of us. Also, multi-generational support. I think we're now, grandkids now. So we have families, the son or daughter, and then now we're working with grandchildren, which is fun and awesome as well. And also just more freedom to collaborate and interface with the other specialists in our families' lives. So there's CPAs, there's state attorneys, specialists, business advisors. It's just, we have now been able to become like the cabinet, right? Like this is your team of specialists for your family. Would you add anything to that? Or?
No, I think that's absolutely right. I mean, no product quotas, no revenue sharing. It's all very transparent and clear. And I think one other thing we've talked about, and we said last week, is when a family exhibits a need, or the families we serve exhibit a need as a whole, we can go out and find a solution very quickly, right? The challenge with an enormous firm, that manages $20 trillion or whatever the numbers are, is it's like turning a cruise ship, right? It takes a lot of time. And that was some frustration when we were at our prior stop. But now we had folks seeking the ability to do a will at no cost. And we were able to essentially invest in a software that gives them the ability to do that. They needed tax return reviews. We were able to invest in a software that gives us the ability to provide them a tax return review. Now, this is not tax advice, right? Disclosure. But the bottom line is that took under a month to someone said, hey, I need a tax return review. And I said, let me take a look. Went out, got the product for them next day. So it's something to think about, is that it's a lot more seamless for us to actually work in a quality, proactive way for folks as we go through time.
Yeah, and I would like to add real briefly, like just like the layers of bureaucracy are gone. And this is a silly example, but we use a software service called Calendly, and all of our families have the link. It's tied to our calendar. They can go on whenever, schedule a time to book a time. Like they need to talk to us about whatever. And we're talking to some friends that are other firms that were like the hybrid, not like a big wirehouse, but like they're just not allowed to have that link. So every time they need to schedule plan, it's like this email chain back and forth. Does this say work? Does this say work? And I felt like it's not a huge thing, but it's a very interesting revelation of just like, this is something that helps people get time on our calendar with us efficiently without the hassle of emailing back and forth, and compound that to something that is even more important, like financial planning software, or like you said, the tax planning software. These bigger firms are just either one, not going to roll it out because
Mhm.
it's too expensive, or two, if they decide to, it's going to take months or even years to actually implement it.
And then it's going to be 1/10 of the actual product
Yeah.
because they effectively reduced it so low because they were so worried about the liability component.
Yeah.
Now you always want to be careful. You always want to be cautious of that component, but of
Yeah.
course, corporate America is going to be a little bit more beyond that.
Yeah.
So all these little tools add up, right? It's we always say brick by brick, and as we're building your financial life, it's important to have all of the best tools possible, all of the best materials possible, whether it be something as simple as a scheduling link that we are proactively calling people all the time, to software to help provide a will, to software to help review tax return, to do performance reporting, to invest in the optimal way without any subjectivity, right?
Yeah.
Everything's objective and clear. So we probably went a little bit long, but
Yeah.
what, anything else you have?
Yeah, and I would say again, I want to be fair because we're trying to be fair. Like independence, like an independent firm doesn't automatically mean excellence,
Mhm.
right? If folks are independent, you still need to do your due diligence. You still need to make sure that they are holistic, they're fiduciaries, and a lot of folks would say very bluntly, Jacky, why should I hire you? I tell them I just do my job. Like if I say we're going to tax plan for you, we're going to tax plan for you. If we're going to do a estate plan, so on and so forth. So just because they're independent doesn't mean they're excellent. You still have to make sure that they are doing what they say they will do. So quality will vary firm to firm, and understanding their fee and cost structure, because they can be independent and the variability of how they charge changes from firm to firm. So again, I want to be fair and make sure that we talk about the pros and the cons on that as well.
Exactly. And like we started off, there can be great high integrity advisors at every firm. These are just our views based on things we've seen in the past and things we routinely see going forward or will see going forward.
Yeah.
Close this out.
Yeah. So again, everyone's journey looks different and every firm looks different, and it might make sense for you now. It may not make sense for you later. So understand the pros and cons. But if you do ever have a question or anything, don't hesitate to reach out to us. And also, thank you folks who've been giving us ideas of things they want to discuss. This is actually a product of someone who watches, of the dozens of people who listen to us. Thousands, the millions.
Yes.
But yeah, appreciate everyone for listening or watching. I'm Jack Petit-Homme. This is
Truly DiLeonardo.
And yeah, we'll see you next time.
Thanks.